Silver hit $120 an ounce earlier this year. Then it crashed. Then it climbed again. And right now, something is happening in Shanghai that Wall Street is completely ignoring. Inventories at their lowest in 11 years. Paper claims on COMEX running at 400% above deliverable supply. And China just locked down 60 to 70% of the world's refined silver with export restrictions that run through 2027. I'm going to walk you through all of it, the data, the mechanics, the real scenarios. By the end of this video, you'll understand this market better than 99% of people talking about it. Stay with me. Silver sits in an uncomfortable middle ground between precious metal and industrial commodity. About 50 to 60% of all silver demand every year is industrial. Solar panels, electric vehicles, semiconductors, medical equipment. You can't swap it out for copper and get the same result. It's genuinely irreplaceable in most of its core applications. So here's where we are. Silver hit all-time highs above $120 earlier in 2026, then corrected back to the $85 to $88 range. A lot of people looked at that correction and said, okay, the run is over. But here's the thing, the price corrected, the fundamentals didn't. Supply deficits are still building, inventories are still draining, delivery pressure is still rising, and that gap between where the price is and where the fundamentals point doesn't stay open forever. There are 5 interlocking stories driving this market simultaneously. A structural supply deficit, a delivery squeeze forming on COMEX, an inventory crisis in Shanghai, China restricting its silver exports, and a macro backdrop that historically supports precious metals. Let's take them one at a time. The 300 million ounce supply deficit. The global silver market is projected to run a supply deficit of approximately 300 million ounces in 2026. To put that in context, that's roughly a third of total annual global mine production. Every mine on Earth operates normally, produces everything it's expected to produce, and we still come up a third short of what the world needs. That is a structural imbalance, and it doesn't fix itself quickly. Where is the demand coming from? 3 places mainly. First, solar energy. Modern photovoltaic cells use silver paste to conduct electricity, and as panel efficiency has improved, the amount of silver per panel has actually gone up, not down. Second, electric vehicles. EVs use silver in battery management systems, circuit boards, and charging infrastructure. Third, AI and electronics infrastructure. Data centers, 5G networks, defense systems. Every major technology trend of the next decade is silver intensive. On the supply side, about 70% of global silver is produced as a byproduct of mining other metals: lead, zinc, copper, gold. That means when silver hits $120, you can't just spin up new silver mines overnight. The supply response is slow, constrained, and often determined by the economics of the primary metal, not silver. Add political instability in major Latin American producing regions, and supply redirected toward the US to arbitrage tariff differentials, and you have a market where every year the world uses more silver than it produces. The deficits compound, and they're funded by drawing down stockpiles that are, as we'll see, running very thin. COMEX, paper promises versus physical reality. COMEX is the main US futures exchange for silver, effectively the Western world's silver price benchmark. Most futures contracts are never settled by actual physical delivery. Traders use them as financial instruments, hedging, speculating, managing portfolio exposure. Contracts get rolled, cash changes hands, no silver moves. This works fine as long as there's credible physical silver backing the system. COMEX tracks 2 categories of silver: eligible inventory, silver in approved warehouses not explicitly designated for delivery, and registered inventory, silver specifically available for immediate delivery against a futures contract. That second number is the one that matters during delivery season. As of early March 2026, Registered silver sits at only 86 to 88 million ounces, while total open interest, the total paper claims outstanding, runs at 400% above that registered stock. 4 times more paper promises than deliverable silver. For most of COMEX's history, that ratio hasn't mattered because almost nobody takes delivery. February 2026 saw a record 25 million ounces of physical deliveries in a single month. Then on March 1st notice day, 52 million ounces of contracts stood for physical delivery, against only 86 to 88 million ounces registered. More than half the available supply claimed in one cycle. And total COMEX silver inventory is down 31% since October 2025. The system is not broken yet, but the pressure building inside it is unlike anything we've seen in years. The Shanghai situation. This is the part I really want you to pay attention to. What's happening in Shanghai right now has the hallmarks of a classic supply squeeze, and it's getting almost zero coverage in Western financial media. Silver stocks on the Shanghai Futures Exchange and Shanghai Gold Exchange have hit a 10 to 11-year low, 300 to 400 tons, down 43% since November 2025. Single-day drains of nearly 40,000 kilograms. The rate of outflows is not slowing. When inventories fall this fast, the exchange's ability to guarantee delivery in a large demand event becomes genuinely uncertain. Physical silver in Shanghai is trading at a $9 to $11 premium over the London benchmark, about 11 to 12.5%. Historically, that premium is less than $2. A 12% premium is not a technical blip that gets arbitraged away in a day. It's a signal that physical silver in China is scarce in a way global prices haven't yet fully reflected, and that the normal mechanism equalizing prices between the two markets has stopped working. Normally, futures contracts for future delivery trade at a premium to spot, the cost of storage and financing. Backwardation is the opposite, near-term contracts trading above later-dated ones. It means the market is willing to pay more for silver right now than in 3 months, because it believes silver is scarcer today than it will be in the future. The SHFE front-month silver contract is currently in record backwardation, the exchange's clearest possible signal of immediate physical scarcity. Reports in the market indicate a single institution holds a concentrated short position of approximately 484 tons of SHFE silver. That is larger than the total available inventory on the exchange. If the longs decide to stand for delivery, there is literally not enough silver in the system to fill that order at current prices. The entity holding that short would have to source silver from elsewhere at whatever price the market demands. The institutions on the long side know this, and they have every incentive to keep applying pressure. The exchange has already restricted accounts for what it called abnormal trading. When regulators intervene on position limits, it's a sign the market is under genuine stress. China's export controls and the macro picture. Now, why can't China just export more silver to ease the tightness? Because on January the 1st, 2026, the Chinese government made that significantly harder. They implemented a licensing system that requires silver exporters to produce at least 80 tons annually, maintain $30 million in credit lines, and receive explicit government approval. Only 44 companies in all of China qualify. Every smaller and mid-sized refiner, entities that previously contributed meaningfully to global supply, is now effectively blocked. These restrictions run through the end of 2027. This is not an isolated policy. China did the same thing with heavy rare earths in 2025. Export controls on dysprosium, terbium, and others critical for EV motors and military systems. Then tungsten, then antimony. The pattern is clear. China is identifying materials where it has dominant supply control, classifying them as strategic, and creating licensing frameworks it can tighten or loosen as geopolitical conditions require. Silver has now joined that list, a metal used in solar panels, defense electronics, and semiconductors. With US-China trade tensions running hot and tariffs escalating, there is no obvious reason to expect these restrictions to ease before their scheduled end date. On the macro side, the U.S. Producer Price Index just posted its largest monthly increase since January 2025. Producer-side inflation that historically supports precious metals as hedges. Meanwhile, ongoing legal uncertainty around the Trump administration's tariff powers, including potential Supreme Court challenges, keeps risk-off money in gold and silver. The technical picture shows short-term overbought signals. Gold's RSI is approaching 70. Silver just went through a steep correction and is sitting on a key Fibonacci level. StoneX analysts have noted both metals may need to unwind before the next move higher. That's a credible view. Short-term, there is volatility risk in both directions. But the medium-term fundamentals, the deficit, the inventory drain, the delivery pressure, the export restrictions, those remain completely intact. 3 scenarios from here. So where does this go? 3 honest scenarios. The base case, silver trades sideways in the $80 to $90 range. Inventories stabilize slightly. Some positions roll rather than stand for delivery. The market digests its enormous prior move and waits for the next catalyst. This is actually the setup that creates the cleanest foundation for a subsequent move higher. It lets speculative froth come off, while the structural tightness continues building underneath. Delivery pressures on COMEX intensify in the April or May cycle. Shanghai inventories fall through 300 tons. A geopolitical shock, breakdown in US-Iran talks, Taiwan Strait escalation, a tariff surprise, sends safe haven money flooding in. Silver breaks through $90 and moves toward 100 to 120, retesting the prior highs. The move would be fast and volatile in both directions, not a peaceful grind. Low probability, high impact. The 484-ton short on Shanghai cannot cover through normal means. COMEX registered stocks continue their 31% per 5-month drawdown rate and hit critical lows during a high delivery cycle. China's export restrictions mean there's no emergency safety valve. Prices gap violently upward, not a steady climb, a discovery event. Analysts running this scenario are pricing $125 to $150 per ounce, potentially higher. I am not predicting this happens, but the structural conditions for it to happen exist right now in a way they have not for over a decade. Here's the takeaway. Silver in 2026 is simultaneously an essential industrial material, a geopolitical instrument China is actively weaponizing, and a financial market showing structural stress that hasn't been visible in over a decade. The 5 stories we covered, the supply deficit, the COMEX delivery pressure, the Shanghai inventory crisis, the Chinese export restrictions, and the macro backdrop are interconnected, mutually reinforcing, and building toward a resolution. What that resolution looks like depends on developments we can monitor but not predict with certainty. What we can do is stay informed, watch the right metrics, and resist the temptation to either ignore compelling evidence or get swept up in hype. If this gave you a clearer picture of what's actually happening, hit the like button. It helps other people find this kind of analysis. Subscribe if you want updates as this story develops. And drop a comment below. Which scenario do you think plays out? And which metric are you watching most closely? I'll see you in the next one.